Morning Talk on SAFM.
It's 6 minutes past 10 here on SAFM 104 to 107. So we're going to move on. Brian Hirsch with us and talking about the one thing we love to hate, and that's credit.
Not sure if we love to hate it. I think
we hate to love it.
We love it, but we hate it when we have to pay it back.
Yeah.
Very sad week for me because I lost a very close friend of mine last Tuesday night. A friend that's been John Smollen. We've been friends 51 years.
Oh, wow.
We're in business together. We spent a lot of time together, and he had a heart attack and died, 64 years old. So, they always say, and if you want to make God smile, just tell him what your plans are. Because he knows he's probably got more plans for you than we all think down here on earth. But coming back to debt, I mean, it is a real problem. People don't understand, and there's a lot of talk about debt consolidation. And I wanted to just touch on debt consolidation because I read about it. I read about debt counselors. I read about the whole concept of what you can do. The starting point about before you even get into debt is to have your annual budget, which I've spoken about on numerous occasions, and to stick to it. And within your budget, you may be paying off debt. You've got to realize that interest rates are at a 35-year low. It doesn't mean interest rates are going to stay at these levels. There is talk possibly about interest rates coming down. Things aren't getting better in Europe, and there's talk about it. But whether we get interest rates cut, but that doesn't mean in 2 or 3 years' time you can't find interest rates higher than where you are. So you've always got to build into your budget a little buffer of what happens if interest rates go up. What actually happens if I need to pay a little bit more? So don't cut that to the fine, right to the bone, where you think you've got money to pay off debt. Always be prepared for the little bit extra.
Be emergencies, anything
there
can
could.
happen.
Well, that's always part of your annual budget, which people leave out. One of the concepts today is if you get into trouble, you've got to go and speak to your creditors. You can't pretend it's not going to happen. We had a program about a few months ago about garnishing orders where people think, well, I don't have anything. No one can take anything from me. If you're in a job and you owe money, judgment will be taken against you. They can then issue a garnishing order, which means that your employer will be forced to deduct from your salary amount of money and pay it over to all your creditors. So go and talk to your creditors and try and find a solution. Level with your creditors. Don't hide from your creditors. One of the ways of what people are looking at is what they call debt consolidation. If you've got 8 or 10 amounts owing and you consolidate it all under one debt roof, and then you rather pay one check rather than pay these checks. Only do debt consolidation if the interest rate on the total debt is less than the interest rate you were paying on the other account. So if you're paying something like 8 or 9 or 10% on currently, and you're going to do debt consolidation and they want 12% for the convenience of one check, and you're going to pay more interest, it does not pay you to do that. And a lot of people are thinking about using their housing bond. They may have access bonds and they may have some facility in your housing bond. If your housing bond rate, which is normally lower than any other debt, because there is healthy and unhealthy debt. People must remember it's not all unhealthy. To have a roof over your head, to have a bond that you can pay, that's healthy debt because you've got to live somewhere and ultimately you want to have your home paid off. Where you're taking unsecured lending and you're borrowing more money at high rates, that's very unhealthy. Credit card debt's unhealthy. But where you want to consolidate your debt under your bond, make sure that when you take that extra bond and that extra bond is granted to you, you pay it off in the same time than you would have paid that debt that you had previously. So if your debt was 3 or 4 or 5 year debt, make sure it's paid off in 3 or 4 or 5 years. Don't let it become 20-year debt like the rest of your bond. That's the worst thing you can do. So it is an option for you to do that. And then I think what's important is don't take anything on credit because it's available. It's amazing. I bought for the first time. I've never heard this expression, but I had a dinner the other night. I paid with my credit card, and they said, "Do you want it straight or budget?" I said, "I don't. What do you mean straight or budget?" So obviously people are actually paying your dinner on a budget account. I mean, you're paying a ridiculous rate of interest. So understand that using your credit card and then paying your credit card at the end of the month in full. People don't realize if you owe 2,500 Rand on your credit card and you only pay 500 Rand off, the interest will work on from the day one that you got credit on the full amount that you borrow, not just on the outstanding balance. So you need to understand what the uses of credit card. And then what is most important is you understand there will always be extras every month. So when you calculate, I can afford to borrow so much money and pay it off because that's how much I earn monthly, just remember there are going to be other little shocks that come during the month, and that you're going to have to find from time to time. School fees come across, repairs, all different things that happen, birthdays, holidays, all these things that don't happen every month. They come periodically. For pensioners, you certainly need to be looking at other alternatives to provide you with income in the coming years. The enemies for pensioners is not hopefully debt. The enemy for pensioners is inflation, taxation, and the worst of all is longevity. People 30, 40, 50 years ago were budgeting that they would live until in their mid-70s.
Yeah.
Today, people are living in the 90s. I mean, the Queen's got to send herself a telegram in a few years' time when she gets to 100 to congratulate herself. Even her husband, Prince Philip, is, the Queen apparently doesn't even send telegrams at 100. She's now sending telegrams at 110 because people are living that much longer. So for pensioners, one, certainly you can't afford to have any debt. And you've got to realize that if interest rates stay at these levels, or even drop further, it's going to impact, and you've got to look for alternatives, and there are alternatives. That's the problem. Pensioners they just leave their money in money markets, which will never beat inflation. Their inflation rate is running at 9 to 10%. So the point I'm making, with credit, be careful of rising interest rates, but for pensioners, be careful of falling interest rates and also these interest rates staying at these levels for too much longer.
0891104207, 0891104207, SMSs to 34701. The lines are open. Brian here to help you with your personal finance and investment questions. Maybe you have a question about credit or debt, or maybe you're in a debt consolidation as well. We can talk about that. There's also issues around, the debt counseling, and that many people aren't going that route, even though they are indebted.
Well, the one advantage of debt counselling is naturally there's a cost. I think there's a maximum cost of 6,000 Rand. Debt counsellors have to be registered. The one advantage is they can stop action being taken against you. So, if you've got all these different amounts of debts and you get judgments against you and the possibility of garnishing orders, there's very little you can do. And that judgment taken against you could stand on your credit record for the rest of your life. So if you go into debt counselling, the debt counsellor will then contact all your creditors to say, right, we are now working with this individual who's in debt. We are going to come up with a plan. We'll give you that plan, how this individual intends to pay each of their creditors off. But the beauty of that is there is a cost to that, and that cost naturally could have come off the amount that you were paying off, but it does stop any judgments getting taken against you, and at least you are now there's more control. You move from what I always call financially disorganized to financially organized because you're forced to be organized.
Here's an SMS from last week that we didn't get to, from Mark, who said, Satrix do not give a flat fee. They get more fees when you invest more. There are no reduced costs to investor for only 4 lump sum investments. What's your comment?
Well, I don't have any comment on that because my understanding is Satrix got a set fee somewhere around about 0.8%. Yes, they don't reduce the fee because your investment is higher, or as you say in your particular case, as you put more money in. I think it's a flat fee. But if you compare that to the rest of the industry, the rest of the industry is a lot higher than that. It can, if you look, they call it the TER, which is total expense ratio. What are the total expense ratios? You can open the papers on a Saturday morning, the personal finance section. You can open the financial section in the Sunday Times business section, and you'll see the TER of all the different unit trusts, and they range between 1.5% and 2.5%. So it's certainly a cheaper way of getting into the markets. It's a passive way. It's not going to be managed on your behalf. It's going to perform on the same basis as the market, rather than an active manager who says, look, I don't want to be in Anglos at the moment. I would rather be in retailing stocks. I would rather be in something in slightly different sectors to the traditional big stocks in our market, namely Anglos and Billitons and Sassels. So that's the advantage. But from a point of view, you're right. The fee is very standard.
Someone says, what are the advantages of having an access bond?
Well, the advantage of an access bond is that the best, if you've got spare funds and you put it into your bond, the rate you're getting after tax, because your bond that you pay on a monthly basis is after tax rands. If you're earning money, you pay your tax, then you pay off your bond. If you put that money into your bond, then the rate of interest that you're paying on your bond is the rate of interest you'll save. Now, if I've got money in a money market account, I'll be lucky to get 4% with small amounts of money, and if I've got slightly more, 100,000 upwards, I may be getting 5.25%. But if I'm paying on my bond 8.5%, and I'm putting the money into my bond, then I'm saving 8.5% interest on the amount I owe to the bank, which is a better rate. And if you ever need that money on your access bond, you can take it out again. So very different to trying to find credit, because you've got that credit there yourself. You do always need to check with your bondholder, because things do change, that if you do reduce your access bond, have you still always got access to those funds? Because the National Credit Act, which came in, I think, in July 2007, changed the rules slightly. But that's the advantage of an access bond.
Njabula says, hi, I'm 25. I want 300 Rand monthly property fund in my portfolio. Which one can I invest in? Can I invest with Marriott Asset Management Property Fund or PropTrax ETF Fund? Well,
they're both very good funds. I mean, Marriott is a company owned by Old Mutual. It's always done very well. If I was putting my money 300 Rand away, I would go into PropTrax. It's got there are two PropTrax. There's one that links into all the property funds. The other is the PropTrax 10. It links to the top 10. I've got money invested for my clients in the top 10. It's buying the top 10 stock property funds. You're getting an income return of somewhere around about 7%. That is taxable. Naturally, there are some tax-free allowances for people over 65 and under 65. And then you can participate in any growth. Now, those funds have had a very good run. Over the last 9 years, they've outperformed the market, and they've had a good run again this year. So don't think that those property funds will just continue to move ahead. There can be times when they could just stay level, and there could be times when they drop. When interest rates start to rise, property funds are a function of interest rates, and you could find them coming down. But I think it's a pillar of investments, property and equities, and I think that's a good place to be.
Is it true that 1/3 of pension fund will not be paid as from 2014, as is the case now, but only monthly payments?
No, I think you've got that story incorrect. They are looking at the Pension Fund Act. They're looking more at the Provident Fund. The difference between a pension fund and a Provident Fund is when you reach retirement, under a pension fund, which can include any corporate pension fund, government pension fund, or your own retirement annuity, 1/3 can be taken in cash. There are certain tax-free levels. 2/3 has to buy a pension. Under a Provident Fund, when you reach retirement, all can be taken in cash, and there's talking about putting some cap on that to stop people taking it. But the statement made by Revenue and in the budget was that all previous vested interests would be protected. In other words, if you were in a Provident Fund and previously at this point in time, you can still get your cash. They wouldn't tamper with that cash. You will pay tax on it. So the 1/3 applies to pension and Provident, and the 2/3 then has to go and buy a pension.
All right, we'll read more. There's a couple more SMSs, and we'll take calls as well on 0891104207. SMSs 34701.
Morning Talk with Siki Mgabadeli.
22 minutes past 10. Let's read an SMS, Brian, and then we'll take the calls. Rachel in KZN says, I have 2 judgments against my name already. Can I still get help from debt counseling?
Well, Rachel, if you owe money to anyone else, and I suggest you do get some help, we at least stop any further judgments being taken against you. And also maybe the Debt Council can advise you what you must do about those judgments, because the fact that judgments are taken, you owe the money, and they're going to claim that money from you. Now, you've got to find a way of firstly repaying what you owe based on the judgments taken against you, and then at some stage you want to try and get that your name cleared off what they call the list of offenders. I mean that will count against you for the rest of your life if you don't have that cleared up. You need to get those amounts paid, and you need to get confirmation that those amounts are paid. Your name may not be removed, but at least if you ever need to get credit in the years ahead, you can show that you have paid off your debts. And if you, I repeat, if you've got any other debt, I suggest you go into debt counselling before you get other judgments. I mean, there's no point getting 6 or 8 judgments against you. They'll get garnishing orders on your salary, and you'll end up taking home nothing.
Let's hear from Linda in Centurion. Hi, Linda.
Hello.
Hi.
Hi, Brian.
Morning, Linda.
Yes, no, I want to ask, I'm contemplating to invest in a very risky asset on a JSE. Now I want
Sorry,
to know,
Linda, did you catch that?
Wants to invest in a risky asset on the JSE.
Yeah, but no, the question is, what happens when a company decides to delist?
Well, if the company decides to delist, one or two things can happen. Either they'll make a payment out to minority shareholders, or they could end up delisting and the minority shareholders will get nothing. It all depends on the reason for delisting and what's going to happen to that company thereafter. If the company is moving away from being a public company to a private company, it has to make an offer to its minorities, and if that's accepted by the shareholders, then they will pay out. Now, there have been quite a few companies that have delisted over the years, which have cost shareholders a lot of money. Shareholders would have liked to have remained. We had Verimark that wanted to delist at 30 cents, and the shareholders didn't agree with it, and then 3 or 4 years later, the business improved. The share went to R2. So those shareholders who stayed along for the ride could have really done well. The share's trading at about 120. There have been other shares that have delisted. Edcon delisted. Nando's delisted. And if I remember, Brandcorp delisted. So there have been other companies that have delisted, and maybe shareholders wanted to stay along for the ride, but they got paid out. So sometimes you talk about being, risky assets. I don't like investing. We're not talking. You must never talk about investing with risky assets. Investing is a long-term business. You want to be in solid and secure investments. You need to take risks to achieve growth. You need time, but you still want to be with quality companies. When you're taking risk and you're sort of speculating, that's very different to investing.
All right, yeah, clear. But,
thanks.
Okay, Brian, thank you.
Thanks,
Linda. Neville in Durban. Hi, Neville.
Thank you.
Morning, Neville.
Thank you, Brian. I listen to your program every week. It's very interesting and very knowledgeable. I have a question to you, Brian. Many times I see you ask people to invest in a long term, like with institutions like the Satrix, Allan Gray, Coronation, and today I think you mentioned PropTech. Now, my question is, how safe is the money? Because if you consider in the past you had some of the companies that fold up. I think it's one of them was Master Bond and the Supreme Bond and a few others. And I just want to know how safe is the investors' money with all these institutions that are offering investments.
All right. Will you listen on the radio for me, Neville?
Sorry?
Will you listen on the radio for me?
Okay, fine.
All right. Thanks.
Neville, I always talk about stick to the brands, the well-branded companies. You've mentioned a couple of companies that really, it was always the greater the risk, the greater the return. And I always say that happens to be the biggest lie in the world. The greater the return, you could lose all your money. And a lot of those companies you've just mentioned were paying much higher rates of return. These companies that you've mentioned, there is two levels of risk. You talk about corporate risk. What is my chance of that corporation or that institution going and not surviving? And when you're talking about brands and all the names, by the way, I never recommend one. I answer questions, what I like to say, which is tabletop answers. I always say people should go and seek advice from a financial advisor to understand their individual circumstances. Everyone's circumstances are different. But you mentioned companies like Allan Gray, Coronation, Satrix, PropTrax. These are safe organizations. However, so from a corporation point of view, I have no problem as long as you know it's a well-branded company. Names like Liberty Life, Metropolitan, Sanlam, Old Mutual. I could go on. There's many, many more. They're safe organizations, and the corporations will survive. But within the investments, they invest in companies, and that's why I was talking to Linda earlier about investing with risky companies. If you're buying brands, if you're buying into the Growth Points and Hyprop, these are solid property companies. If you're buying into companies like Sasol and Anglos and Billitons and Liberty Life and Standard Bank and Nedbank and companies of that ilk, not tipping any names, just mentioning them, then those companies are pretty secure companies. But when you start going down into the bottom 400 or the last 200 of listed companies, very difficult to do due diligence, and we see some poor results coming from those smaller companies, and that's why those institutions stay away from them. So I don't think there's any risk in terms of the corporation. There's always risk to investments because markets go up and down. Property funds don't only go up, they also go down. And sometimes people don't hear that. They think everything, you just buy today and everything's going to go up tomorrow. To achieve growth over the long term, the word growth, I like to use the letters. G is for growth, R is for risk. I'll move to the last two letters. T is for time that you've got to have, and H is to hold those investments, not to try and get in and out. W is for the letter wealth, to create some wealth, and then the O is you as the individual, you being the individual who you're investing for. But that's what you're looking for. When you take growth, there's risk. When you put money in the bank, you know that I'm not taking any risk. However, the risk is, will you beat inflation? And the answer is no.
All right, lots of SMSs that have come in, so we're going to have to deal with them next week, I think, because we've got can you believe that it's already the end of June?
Well, do you realize that Thursday you can go to bed early because it's the shortest day of the year?
Really?
And then Friday morning the days start to get longer and it's countdown to summer.
All right, let me read one more. I think we
Okay.
can maybe deal with it with this one because it deals with the topic today. Does it make sense to save when you have debt, e.g. unit trusts, RAs, etc.?
Well, there's a big difference between RA and unit trust because RA, depending on your tax position, you are getting a tax deduction. So I'd like to exclude for today the RA. It doesn't make sense to be in saving in unit trust if you've got debt. But again, depending on the cost of that debt, we all plan to have no debt at retirement. We want a good healthcare program, and you want a home paid for. So I don't see your home being your debt because that's where you live. You'd have to live somewhere. But if you've got other debt where you're paying much higher rates of return, and those rates of return, that cost of debt is higher than the rate of return, then you shouldn't be saving. But everyone's circumstances are different.
All right, we'll pick up the rest of them next week. We'll see you then. Thanks, Brian. Have a good week. Brian Hirsch joining us, of course, next week for 1 hour. So you can always send me an email ahead of that, and we'll read it out next week. It's siki@safm.co.za. But if you'd like to talk to Brian off air on his radio line, it's 011-880-4888, 011-880-4888, 4888.